Well, our data tells a story of tremendous growth for active ETFs. If we look at the start of the decade, active ETFs represented 0.5% of the industry. In the middle of this decade, they're around 3.5%, and we expect it to be around 7% by the end of the decade. So tremendous growth. The second thing is we see tremendous product development. We this year we've seen over 500 new ETFs go to market. Our data shows about 1,500 funds that have registered with the SEC that are waiting approval. So we've seen tremendous product proliferation. And we see, a further explosion. The SEC recently uh, gave approval to the first firm to offer ETF share classes to active mutual funds. There's another nearly 80 firms in the queue waiting for approval, representing trillions in assets under management. And so this represents the next stage, the next evolution in the mainstreaming of the ETF as the preferred investment vehicle of choice. If managers are thinking about launching an active ETF, there's a few things that they need to keep in mind. The first question they need to ask themselves is, what are we good at? What are our core capabilities? The ETF does not have a Midas touch. It does not automatically take a lackluster investment strategy and turn it into gold. So I think that's the most important thing. What are we good at? The second thing I think you need to think about is the go-to-market strategy. How are you going to approach this market? Are you going to try to provide a broad suite of capabilities that can fit across an investor's portfolio? Or are you going to try to specialize? You're going to find a few things that you're really good at. There's an unmet market need, and you're going to go for it. The next thing you need to think about is how you're going to launch active ETFs. There's more than one way to enter the market. Maybe you might have an existing mutual fund that you want to turn into an ETF. Maybe you want to launch a new product, or maybe you want to go the ETF as a share class route. Each of them will have different advantages and disadvantages. Do you want to enter the market with an existing track record, or do you want to start something new and do something different? So I think those are the things to really think about. And last, though, is pricing. It's really crucial, especially in the equity side of things. You'll see a lot more price competition in the ETF arena than in the mutual fund arena. And what constitutes a reasonable price as a mutual fund is not reasonable within the ETF realm. So it's much more price competitive. And I think that if you go to market with too high of a price, then your chances of success are much reduced. Well, when we look at institutional holdings of ETFs, we see roughly $7 trillion in institutional ownership of ETFs. Most of that is passive, but something like 750 billion is active. So we see widespread institutional ownership. And by institution, I don't just mean large asset managers. I also mean wealth managers. And I think that tells us something about active ETF demand. It's not just something that do-it-yourself investors at home are interested in. It has real institutional buy-in by gatekeepers, by advisors of all stripes. And one thing that we see is that fee-based advisors, especially in the RIA space, are keenly interested in active ETFs. They have disproportionate ownership in active ETFs. So for asset managers that are looking for places to grow, particularly in the RIA segment, which is the fastest growing of all of the wealth distribution channels, it's an attractive entry point uh, for asset managers to consider. Here's what managers need to know about pricing in the active ETF space or in the ETF space in general. When we think about pricing, ETF providers might be a bit discouraged to see that most of the assets, in fact, 70% of all of the assets are in funds ETFs that have 20 basis points or less in expenses. Low cost, low fee, hard to generate revenues. However, there's a real difference between where the assets are and where the revenues come from. In fact, something like 75% of all of the revenues are earned outside or of funds that are of ETFs that are charging more than 20 basis points. And so that tells a more encouraging story that it's not just the cheapest ETFs that are selling. In fact, there's a sweet spot probably within the 20 to 40 or 50 basis point range where you see a lot of revenue potential, and you also don't see this kind of phenomenon that you see among really pricey ETFs or the cheapest, where it's a handful of players get all of the assets. So kind of that middle tier is kind of a sweet spot where there's more opportunities for managers to grow. Another thing that I'd like to point out is the ETF, the conversation about fees has changed a lot within the past 5 to 10 years. It used to be all about price. Find me the cheapest ETF possible. But now, for the first time in a long time, there's a discussion about value. And price and value aren't quite the same thing. Price is what you pay, value is what you get. And there is a conversation to be had um, around very differentiated, unique strategies that, provide something unique or different to the end investor. I think of something like buffer funds. These products are not inexpensive by a traditional measure, but they provide a service that advisors and investors, highly value. And so there is some room that if your product is different enough, it does something um, that other tools can't do quite as easily or quite as effectively, there is room to discuss your whole value proposition. And, it's not just a race to the bottom on price. Well, you'll never hear a client say, "Oh, we're not thinking about the active ETF space." So it's not really a matter of if, it's how and when. Um, we could start with the when. I think asset managers view this with a certain degree of urgency because we see, especially in new product categories, you have a handful of players, they rush in and they capture an outsized share of the available assets and flows. And so nobody wants to become a Johnny come lately to, a fast growing space. I think they're concerned about speed, and I think they're also concerned about how they get to market. Are we going to convert an existing product? Are we going to create a new product? Are we going to add a share class to an existing mutual fund now that that's an option? And a thing they're also keenly worried about is this issue of cannibalization. Um, you know, it doesn't look like an attractive economic proposition to launch a lower fee ETF, have it attract assets from one of your higher fee mutual funds that eats a lot of your revenue, and all of a sudden you end up worse off. But our data shows that cannibalization so far hasn't been much of a problem for most active ETF providers. They're not stealing assets from their own funds by and large. They're attracting assets from rivals. And so far, active ETFs have been a growth engine for managers. Uh, I think that'll be less true going forward as more managers enter the space. As they offer more products across asset classes, it increasingly becomes more of a zero sum game. But for now, I think there's uh, in a fast growing space, there's a lot of room to swim around without bumping into your competitors. If I think of the standout performers, I put them in three buckets. The first are the diversified portfolio providers. They're dimensional, which or capital groups, some of the largest players in the active ETF arena. Here, they're playing everywhere: equities, fixed income, and international U.S. And so, if you like their mutual funds, you'll probably like their ETFs. They have, they're well entrenched in among wealth managers. Their brands are well known, and they're able to leverage their existing capabilities in mutual fund or in ETF form. So that's the first group. The second, I would say, would I would call them focused franchise players, and J.P. Morgan kind of resonates with me. They're, I think, the second or third largest active ETF provider. And how do they get there? Well, they have a handful of really successful funds. Two of them are derivative income funds. JEPI is a very well known, almost $40 billion ETF that provides market exposure with this derivative overlay that helps generate income. And investors are really attracted to that because not only do you have the word income, you also have the promise of some protection from market downturns. And they also have a very successful ultra short product. So a handful of franchises driving a lot of growth. The third bucket are niche players, that have identified, a small segment of the market and, have captured a really large share of it. And the firm that epitomizes that is Innovator. A lot of people haven't may not be quite familiar with it, but its product, uh, first buffer fund product went live in 2018. So less than 10 years later, it's within striking distance of the top 10 list in the active ETF arena. And how do they do that? Well, they took a strategy that advisors previously were doing on their own with high net worth clients. They would use a variety of option type strategies to protect investor returns if they're exposed to the equity markets. And, that those were bespoke portfolios previously. Well, they're using the ETF technology to do something that previously was bespoke. Now it's not. And so the access to this strategy has kind of been democratized and, provides it meets different, uh, advisor needs, it meets the investor needs, and investors, love the concept of, exposure to risky markets, but, with a buffer that prevents them from suffering, outsized losses.